Okay, we're live. Thanks everybody for joining us. This is a very exciting thing for us to facilitate as a grassroots advocacy organization, WeTheInvestors. We're here to advocate for greater transparency. Grassroots advocacy organization, WeTheInvestors. Is that you, Alex? Here to advocate for on the Twitter space. Transparency. Grassroots advocacy organization. Is that? There we go. Take two. All right. Yeah, I think you must have the YouTube stream open in a tab or the Twitter space. So here we go. WeTheInvestors, again, is thrilled to convene this second Q&A session with SEC Chair Gary Gensler. WeTheInvestors is a grassroots advocacy organization, and we are focused on improving transparency in markets, improving competition, increasing individual investor participation in markets. And we're thrilled to have you here joining us for a second session, Chair Gensler. So thank you for doing this.
Dave, thank you. And thanks to all the listeners. I look forward to a lively discussion.
Yeah, so, we're just going to dive right in. I think the last time that we met, there was a lot of ground that we had to cover, a lot of basics that we had to get past. This time, we're going to jump into some detailed questions. So I wanted to start just by giving everyone an overview of what we're going to talk about, because unless you stick around for the whole thing, you might not realize that there are some topics that we've covered. So we're going to start out by talking about an issue in markets that we know a lot of people care about, which is FTDs, failures to deliver. Then we're going to have a conversation about direct registration, the DRS system, and how retail and individual investors are choosing to move their shares out of their brokers and into their own names to have that direct relationship with the companies that they're investing in. We're going to talk about some of the new SEC proposals that have come out, some very transformative rules that I know that you spearheaded, and ones that will really fundamentally change some things about markets, especially in terms of that pipeline for retail investors, where you have off-exchange trading, wholesalers and internalization, and a lack of competition for that off-exchange trading space, and a lack of an impairment to the price discovery process because of it. We'll talk about some of the Reg NMS changes to tick sizes, best execution. We're going to want to talk a bit about some how the SEC approaches enforcement, and the kind of feedback that we hear, and then we'll see if we have more time to talk about other things. It's a pretty big plate that we've got here. But to start, I did want to ask you just real quickly. A lot of people ask me to ask you about a stock that they care about. A lot, everyone has their stock. Many people have multiple ones. If I were to ask you about a specific company, what would be your reaction? Would you be able to talk about the situation that a specific company or a specific trading activity in an individual stock?
There was a saying when I lived up in New York. Sometimes somebody asked you a question, you couldn't quite answer it. You'd say, "How are those Mets doing?" Look, I would say this, Dave. We are, for two reasons, it's hard for us to talk about specific companies. One is we're very much a disclosure-based agency. We're focused on making sure that we protect the investing public against fraud, manipulation, and our rules are followed and the like. Secondly, we're also a law enforcement agency that brings about 760 law enforcement actions a year, civil law enforcement actions. And so we don't really talk about any one company in that context either. So I hope that helps you, but we can talk about policy. We can talk generally about the functioning of the market, not the levels of the market and the like.
Yeah, no, I understand. And I think maybe that's not 100% clear to people in terms of, the way they think we should approach these things, and that's fine. But I respect that, and I think that it's more interesting to talk about market structure and the changes that are.
I'd also say this, Dave, if you've got a question or some of your viewers have questions, that they can make it more generic about something they see that's going on in the market, we learn from that. And not just me in this call, but the people at the Securities and Exchange Commission that helped prepare me for the call, but are listening now to this dialogue and thinking about it. We'll look at the transcript later. We actually even take this entire transcript and then put it into the comment files because we have open rulemakings on a number of these matters.
Okay, that's great. I didn't even realize that. All right, thank you. So
you are part of the administrative record, my friend.
All right, so to add to that administrative record, I'm excited to bring up Platinum Sparkles to ask our first question.
Hello.
Good to see you, Platinum.
Hi, good to see you again. Thank you for joining us. So I'm Platinum from Superstonk on Reddit. We recently asked the community for questions for you, and the overwhelming majority have questions about FTDs and why they're allowed to exist. So Reg SHO set out to reduce FTDs and limit how long an FTD can persist. But there are loopholes, and people are concerned that these loopholes are being exploited. Why are FTDs allowed in modern electronic markets? And what do you think is causing millions of FTDs per day?
Look, I think you all raise an important question. Fails to deliver. I mean, the history comes from a paper world where you might literally show up to do a transaction and be unable to settle the transaction. But you're right. In an electronic modern era, you would say, what is this about? Why would this still occur that you might, quote, fail to be able to deliver this security? I think we're doing a number of things to lessen that, to lower that. Even this rule that we finalized a week or two ago about shortening the settlement cycle from 2 days to 1 day, we added something else. We said on the same day that a trade happens, the very same day that you have to what's called affirm, confirm, and even allocate the transactions electronically that day as soon as technologically practical. We did something in addition that didn't get much press about what's called straight-through processing so that all the electronic pipes connect. But I share your thought that in the modern digital age, you would really think this would be at most a de minimis thing that happens because of some electronic glitches.
Yeah. So you're saying
these are being used nefariously? Do you think they're being that these loopholes are being purposefully exploited?
I think that you raise a good question, Dave, and that's really the question that I think is at the heart of probably many of the contributors. Is like, if it's just an error, it's just an error. That's one thing. But is there any manipulative action? And that's really what our enforcement division, the 1,300 professionals in our enforcement divisions from time to time have to think about. The actual statistics are that it's a very small number of fails to deliver, not small in numbers, but small as a percentage of the daily trading. I mean, because there's such big numbers of daily trading. But your question is the right question is like, might there be anything that's manipulative? And even if the vast majority of trades deliver properly, those fails deliver, maybe the vast majority of those, I'm not saying this to get anybody off the hook, because anybody that's using manipulation around this then needs to be held accountable.
Do you think, though, that, and maybe this is getting too in the weeds, but the NSCC netting process could result in the understatement of the actual incidence of FTDs? So, I've heard different numbers. I've heard 1% or so of all trades in equities fail, or 3 to 5% maybe overall in the market, although I think that's dominated by ETFs. But if the netting process is something where it's actually sort of hiding or obfuscating the actual incidence of fails, is that a problem?
Well, I think transparency is really important in each part of our markets, including in this topic around fails to deliver. It might be something that you'd even want to follow up and talk to our folks directly in the Division of Trading and Markets and and not isolated just to this call, but the statistics that have been shared with me are closer to that 1%, but maybe there are statistics that you'd want to point out to us and we'd learn from that. It would be really helpful.
Sorry, Platinum, was there anything else you wanted to follow up on?
Well, last time you did say, because you kind of mentioned it right now, that there's a way that's existed for decades to file something with the SEC if there's a specific thing we think that should happen. So is that what you're talking about? And if so, what is it? What is the way?
I was actually talking about actually having a meeting.
Oh, okay.
I was being more, but there are ways. You're absolutely right, Platinum. There are ways to file, in essence, a request that we do rulemaking or a request that we do certain things. There's also in our enforcement side, tips, complaints, and referrals and whistleblowers. There are many ways there. But I was just suggesting if there was specific statistics or a research paper or something, Platinum, you could send it to us, but also to meet with the staff. Our staff meets with market participants. They benefit meeting with some of the folks that are like yourself in this call. Awesome.
All right. Thank you.
All right. Thanks, Platinum. Appreciate it. Okay, so before we jump into DRS, I guess jumping into DRS, before we bring anyone else up, we sent you that comprehensive packet that was put together by members of the community. I'm curious just to start off with, in terms of direct registration, what did you think of that, and what are your overall thoughts on it?
This, I think, is this the letter that you're referencing that has 36 more days for signatures, and then some related material to?
Yeah, so right, we're actively running this petition under WeTheInvestors to deal with some of these issues, and then the supplemental material that we sent over specifically on direct registration.
So let me step back from the letter because it's going to be a petition, and back to Platinum's question. Those are things. Petitions are actually, formally sent in and considered. But in terms of direct registration, it's something that's allowed right now. In fact, it's not just allowed, it's facilitated by various rules of the Securities and Exchange Commission dating back at least to the 1990s. Of course, in the paper-based days, and I even remember this as a kid, my father never had a bunch of money, but when he would buy 50 or 100 shares of stock, he'd get that physical certificate. He would take it into the bank and put it in his safe deposit box. Literally. But electronically, you can still do that. And we actually have mechanisms that allow for that in our rules and laws these days. So for those investors that feel they'd prefer that for the various reasons as you've laid out, that's available in the current system.
Right. And so I'll bring up Paul Conn. So Paul Conn from Computershare, who operates, I guess, the largest transfer agent and the largest direct registration system out there. So thanks for joining us, Paul.
Thank you, Dave. Thank you very much. And good afternoon, Chair Gensler. Good to be with you.
Good to be with you, Paul.
Thank you. I'm struggling to say good afternoon because it's good morning here in Sydney. So if you wonder why the curtains are closed, it's because there's a lot of sunlight coming through the window.
It's a good international call. And so, Paul, I don't know if there was anything you wanted to start with before we bring up the YDRS group.
Well, I think just to echo Chair Gensler's comments, the direct registration system has been a feature of the marketplace for over 20 years. It's a well and truly trusted part of the market. I think what we found quite surprising and actually quite exciting, but quite surprising over the last 18 months in particular, is so many investors in the marketplace don't know about it. So we need to do a better job of actually educating the investing public and the prospective investing public about what their choices are when they buy and sell securities in the national market. When they do that, they can ask their broker to directly register their shares with the company, which takes place through the company's transfer agent, and that allows the investor to have their name directly recorded on the register of stockholders, and that gives them absolute legal title and a perfect direct relationship with the issuer. So some shareholders prefer that. Others prefer to hold their securities with banks or broker because they're very active in the marketplace. So it's a feature of the system. It's a very good feature of the system. It's possible that we might all want to make some minor enhancement to it, but fundamentally it is available. It's available for all US public companies, and I think we all just need to work a bit harder to get the message out about what the choices are that are available to investors. I guess that's what I would say by way of some opening comments.
Yeah, and Paul, I think you're right that the option is there. It depends on the investing public what they want, holding it in direct or holding it in what's called street name. And there's some pluses and minuses on each side. We at the SEC are neutral to that, but I'm curious, Paul, maybe it's a follow-up, but just if there are things that you see from running a transfer agent business, what helps facilitate for those investors who do want to do direct registration, how to best facilitate that. We, of course, have had it on the rules for over 2 decades, but if there was something that you know from running this transfer agent business to follow up, let us know.
Okay, and happy to just give a quick bit of feedback on that. I would say that almost all listed companies, so talking about equity issuers now, provide for direct registration. So if an investor wants to hold their securities directly, that choice is available to them. Chairman, I agree with you as a company that this is really a choice for investors about whether they hold their shares in street name or direct registered name. We're not trying to interfere. It's an investor choice. Ultimately, this needs to be driven by education, information, and the investors exercising their choice as to how they do this. In terms of how to go about it, after acquiring shares in a security, the investor needs to speak to their broker and ask them to effect a direct registration transfer, which would move the shares from the broker's account at the DTC into the investor's name directly at the transfer agent. The investor doesn't actually have to do anything. That can all be done between the broker and DTC, and in this case, Computershare as agent for issuer. It's an electronic process. It can happen very quickly, and within 24 hours of receiving a transfer from the DTC, we will confirm the registration to the investor. And so it's a very simple process. We just need to increase the awareness of what the choices are available to investors. And I'm sure brokers will be quite happy to do what their client prefers. It'll either be to leave them in a brokerage account in street name or perfect a direct registration.
Yeah, so I think what we'll do now, we've got the team from WeTheInvestors.org, so we're gonna bring them up, and welcome to Miller, Bibic, and Chives. Thanks for joining us, guys.
Thanks for having us.
Yeah, and each of them has a question around DRS. These are the guys who, along with their team, helped to prepare that extensive information packet on DRS.
Okay, hello, Dave and Chair Gensler. I'm Miller. For the last couple of years, I've been heavily participating in social media investing communities, had extensive investment experience. But when I learned about the open secret of the direct registration system, I caught fire. It opened my eyes to the fact that most investors don't actually own the stocks in their name that they think they own. I then began to spend many hours every day for months, one-on-one, helping hundreds of individuals learn the why and the how to direct register stock. This inspired me, with help from a German investor, to create drsgme.org with our goal of educating the masses. In less than a year since then, we've grown into a team of roughly 20 DRS volunteer advocates, and we just launched a second website, WeTheInvestors.org, where we plan to have instructions on how to directly register every US security. Following up on what Paul just mentioned, we believe that investors if provided this information that we have learned, they will likely choose direct registration due to many of the benefits that we're hoping to touch on here today. And that's exactly why we're here, education. So on to my question, it's about retirement accounts. Pensions and retirement plans are often exposed to more risk than what we're told. Not to mention shares in 401ks can be used for locates and lending. Needless to say, risk exposure and dilution can hurt the security's value. On the other hand, transfer agents are not able to lend or sell shares short, but it is very difficult to move self-directed IRAs to the DRS and impossible for all other retirement accounts, those that are not self-directed. So my question is, do you think it's a benefit for individual investors to have the choice of having retirement accounts in the DRS? And do you think this way of holding should be made more accessible for investors that aren't familiar with the DRS?
Miller, I'd have to learn a little bit more in terms of the limitations in the 401k plans, which might also relate to other departments of the government, like the Department of Labor. But as I understand it, it's an investor's choice. Most investors just have their shares in street name. That's how brokerage accounts are often set up. It facilitates that trading and moving in and out of a stock, particularly if somebody is more active. Of course, many years ago, we at the SEC helped facilitate that there is such a thing as direct registration and doing that electronically, and that's an investor's choice. But again, on the 401k plans, if there's some technical issue, I'd like to learn, and that could be part of some follow-up as well.
So you don't know any specific reason why retirement accounts wouldn't be allowed to directly register securities?
I think that the non-401ks, that many pension plans find it facilitates their buying and selling securities to be in street name, and that they've made a choice that is a positive way to approach it. But if there's a technical issue on 401ks, it'd be helpful to learn from you, Dave.
But maybe, Dave, if I could just add to that and just to clarify, because I agree with what Chairman Gensler has said. Computershare as a transfer agent is not separately a 401k provider, so we cannot be the IRA administrator of the account on the books of the company. We obviously can register securities. So I think what we've said in the past is it's possible for the 401k provider to bring an account for the investor directly onto the books, but we can't step into the shoes of the 401k provider, certainly as things stand below. So, maybe this is an area where we do need some discussion about how to ensure that everyone's needs can be met. But I think we're aware that there's some concern about whether or not those can be held on the register. Of course, people can take their shares out of their 401k and hold them directly in their own name, but that undoes some benefits, as we understand, of actually holding through the 401k. So there's clearly a few technical challenges there that we probably need to unpack in a separate forum.
Okay.
Right, and not only the 401ks, but IRAs that are not self-directed IRAs, it also cannot be directly registered, which is the vast majority of retirement holdings, in my experience.
Mm-hmm.
And Paul, does your experience that what Miller's raised is for the same reasons over at the individual retirement accounts?
I think we, as a transfer agent, would be able to administer these accounts if we didn't also have to assume the obligations of being reporting in an IRA sense. So there's some conflict between duties here. And if the third party IRA provider were to come onto the register and could perform those other duties, I think would be fine. A few people have said to us, well, Computershare, why don't you also become an IRA provider, and that will sort this problem out? That's kind of a business case issue that we need to think about in the background. I'm not sure that's the solution to the problem, even though it might solve it if we were to also adopt that role. But it is an area we need to focus on, I think, as an industry.
Just to jump in and kind of speak on the solution, we've actually found that there are only 2 custodians in the US that are willing to direct register self-directed IRAs. So the option is out there and it's possible, but it's just very, very limited access. So like we can't have the majority of retirement accounts going through 2 custodians, but for some reason it's very difficult to kind of bring other custodians on board to this idea to be able to direct register their customers' assets.
So I think this is something that we can follow up on. We do need to move on to the next question, guys.
Sure, well that would be me. I'm Bibic. As you can probably tell from my accent, I'm not from the US. About 5 to 10 years ago, I used to edit videos for HSBC and PwC, and that was my first glimpse into the belly of the beast. I'm now a big advocate for the DRS. I've worked on instructions for how to move shares into the direct registration system for the drsgme.org and ydrs.org efforts. We are currently at over 140 guides for different brokers worldwide, and they are supported in 7 languages with more on the way. My question is about voting rights and direct registration. The vast majority of shares, as you said, Chair Gensler, they are held in street name. And as in 2018, the former SEC Commissioner Rob Jackson stated the following about beneficially owned shares. Today, fewer than 1 in 3 investors have their vote counted. Directly registered shares, on the other hand, have no issues with votes being skewed or discarded. Personally, as a non-US investor, it has been nearly impossible to vote my shares until I directly registered them. Chair Gensler, would you agree that full voting rights and prevention of overvoting is a benefit for both the investor and issuer when shares are held in direct registration? If so, would you be willing to include this on the SEC page regarding the benefits of the DRS?
Well, I think that shareholder democracy is one of the really important aspects of our public markets and a critical piece of our 90-year history. So individual shareholders' ability to vote their shares is a critical feature of our markets. I believe even through street name, individual shareholders should be able to express and vote their shares, have their broker-dealer then properly make sure that those votes are counted even on the street name. So Bibic, I think it's regardless of whether it's DRS or street name, shareholder democracy and individual votes need to be properly counted and moved through to the entire system so that the managements and the boards of directors get the clear votes from the people that they work for. The real owners of the company are the ultimate shareholders.
Absolutely. I mean, unfortunately, at the moment, that with the kind of excessive liquidity in the markets and FTDs and short selling, a lot of street name investors are they go to vote and the broker tells them they have voted, but their vote isn't counted. Largely, they get discarded or actually voted by the short seller who inherently has no interest in the company. So it's a difficult one. And to us, with WeTheInvestors.org, we believe direct registration is a way of accessing that direct connection to the issuer.
I should have grabbed the statistics going into it, but I do know that there was a comment letter filed a couple of years ago that talked about the number of voting issues and incidents, and it was in the hundreds, documented incidents of votes not being counted, undervotes, overvotes.
Yes.
My understanding is that Broadridge or whoever is operating that capacity will simply truncate the number of votes if they get too many. They'll get more shares voted than what you would expect. So I think that's part of the issue that Bibic is trying to get at.
100%. And on top of that, sorry, I'll let you go, Paul.
Bibic, would you mind? Sorry, because I can probably add something to this part of the conversation, because in addition to being a transfer agent in the marketplace, we obviously tabulate votes for issuers for their shareholder meetings, and the tabulation is both of the directly registered shareholders and the votes that are lodged by agents of intermediaries, so banks and brokers, and you obviously mentioned the largest provider in the marketplace. What we do as a tabulator is ensure that only the number of votes that the bank or broker has an entitlement to on behalf of its customers can be voted. And the industry, and we have been part of this, the Commission's been part of this, we've been working on a vote confirmation initiative for the last 3 years or so. The debate has gone back long prior to that. But I can say as a tabulator, we have for the last 3 years been confirming votes back to banks and brokers at the 99.9 level. So there are very, very few votes that are actually rejected when lodged by banks or brokers with the issuer agent. I think the issue that you're really focusing on is the instructions that come from customers of the brokers, and whether the broker is in fact able to pass on the aggregate number of votes that all of the clients are instructing. And that's an issue which, as an agent for the issuer, we don't have any visibility over that. All we can take is the vote that's come from the broker. So again, this is an issue to do with transparency and ultimately client reporting from the broker back to its client as to whether its vote counted or not. We are certainly confirming back to the bank or broker how their aggregate nominee vote has occurred. So the chains are being put in place, and we need that reporting to go the whole length of the chain so that investors can have confidence when they're voting through the street system. Of course, when they're voting directly because they're holding the securities directly on the register, that's a direct interaction between the investor and us as agent for the issuer. And we don't have the complexities of intermediated parties and agents of intermediated parties in the system. So I just mentioned that. I think the industry has made tremendous steps in the last couple of years to improve this process, but there's still a few steps to go.
All right, thanks, Paul. Yeah, and so real quick, we'll move on to Chives for the last question.
Yes, and thanks so much. I'm glad to be here, and it's a perfect jumping off point. It seems like the common thread through a lot of the discussion so far is the obfuscation that exists and the opaqueness that exists when there's so many different parties operating parallel or along the same chain of custody inside of the market. And direct registration is an opportunity for investors to enjoy, self-custody, keeping the shares in their own name. My question has to do with more transparency and helping make more individuals aware of a 2004 SEC rule. So a previous SEC administration had passed Rule 17 AD 20 of the Exchange Act about 20 years ago, which codified that issuers could not require or force their shareholders to leave the DTC. And in the ruling, that administration expressed that securities depositories were necessary to ensure prompt and accurate clearance and settlement of securities transactions. And that rule has since been interpreted, from what we found, very broadly by investors, by issuers, and by transfer agents, all that use the market. For example, a knowledgeable staff member at the STAI, Securities Transfer Association, told us that that rule prohibits direct stock purchases from being advertised whatsoever. And to paraphrase Suzanne Trimbett's most recent book, the DTC will only broadly state that they cannot honor requests from issuers to exit the system because it has not been permitted by the SEC. Now, 2 companies have recently started reporting the number of directly registered shares in their 10Q and 10K financial reports. In the context of FTDs and float dilution, leading to concerns about shareholder democracy, and the continuing dematerialization, moving towards book entry electronic securities, Chair Gensler, would you encourage issuers to educate and to share information with their investors about the various benefits of book entry DRS holdings, such as ensuring votes are received or ensuring that shares are delivered?
Chives, thank you for highlighting the rule from 2004, which I think that you mentioned would still be on the books. But in terms of your overall question, again, this is an investor's choice. So you and millions of other people have a choice whether to have your ownership expressed in street name or in this direct registered mechanism. And what we do at the SEC, and I'm glad Paul mentioned some of this earlier as well, is to ensure that we have rules that your votes are counted and that people are held accountable that those votes go through the whole system. You're correct that there are layers in the system and that those layers create some lack of transparency is what you've highlighted. But we still hold people accountable to make sure that those votes are counted and they go through the system. From an issuer point of view, I think an issuer makes disclosure that their investors find material, and engaging with issuers as you have may change what they think that investors find material. I would say, frankly, to date, most issuers have not found it material that investors would want that information about how many shares are in street name versus in direct registered.
But do you think the SEC rule, as it's crafted, prohibits issuers from even, educating their investors about it?
Dave, I think you're raising a good point, but I don't. In this format, you said why I might not speak to specific companies. I mean, issuers, the two issuers are disclosing this already, so I think that probably self-answers your question.
Okay, that's a fair point. Yep.
Dave, yep. Can I just add very briefly to that? I think there's not within this forum here, but in the marketplace, there's kind of a conflation of issues, and the issue to do with can an issuer guide or instruct its investors to withdraw their shares wholesale from the DTC, I think is the issue that Chives was really first referring to. Yes. And I think there is good reason why that principle is there, because if you're going to be a public company listed on a public market, the public markets need access to an efficient clearing and settlement system. So there's some tension between continued listing and that particular rule. This is just my personal opinion. But the other side of the discussion, which is, should issuers be able to inform their investors that DRS as a system exists and investors can exercise their democratic choice to use that system? I think personally issuers should be free to do that. I don't believe those two issues are the same thing, but they're being conflated in the marketplace from my read of some of the commentary. So I think there ought to be a way where everyone's interest can be dealt with. The specific issue of whether specific companies report the actual number of shareholders holding DRS, I think is exactly as Chair Gensler just said, it's a materiality issue. Mm-hmm. And I think this may become a trend in future, we will see. But I think the macro points are different and can be worked through.
Okay, I'm gonna thank all of you for jumping on and talking about DRS. I know it's something that the community really cares about. It's something we've heard a lot about for a long time now. And I think this is just the opening part of that conversation.
And I would say this to Miller and Chives and Bibic and all those that are part of this is it's helpful. Even preparing for this conversation and helping me understand some of the thoughts that you have. So keep engaging. It's helpful.
All right. Thank you. Thanks, guys.
Thank you. Thank you.
I'm going to take one question now myself, and let's jump into the SEC rule proposals. So I've got a question for three of them. So we'll start off with the order competition rule. So my overall question to you about the order competition rule at a high level is why be so prescriptive with this rule in terms of the auction facility, the parameters, that type of thing? We've talked about this before, but what is it that you think is needed here in terms of the the explicit mandate of an auction and in fact the parameters for those auctions. And I should say, we very much support the need to move trading from the off-exchange, the non-competitive off-exchange space to lit markets. That is something I think we agree on, and our entire community believes very strongly in. But why be so prescriptive with auctions versus a simpler rule that would just move trading on exchange and then let exchanges compete and innovate for the best way to fill those orders?
So if I could step back just for a moment, Dave, your question's a very good one, but stepping back, our current equity market structure hasn't been updated in about 17 years, and so much has changed in that time. And we have, in that time, we've grown to a market where about a third to a half of the market on any given day goes to the dark market rather than the lit market. And in individual security, sometimes it's well in excess of that. But in particular, well over 90% of marketable retail orders where you haven't set a limit price are going to the dark market. And so what we laid out is a series of proposals. One of them that you mentioned about auctions, another about best execution. I mean, go figure, but the SEC actually didn't have a best execution role. We relied on the self-regulatory organization, FINRA, for that. We proposed some changes in disclosure. We proposed, fourthly, some changes, important changes about harmonizing the rules in the off-exchange dark market and the on-exchange markets around minimum increments, not just quoting, but where you can trade.
Yeah, which I agree is very important.
Interestingly, I'm going to come to your question. Interestingly, the part of the four proposals that we've heard initially, and the comment period's still open until March 31st, but initially we're hearing a bunch from some of the biggest market participants. They don't really see the path for these auctions. So I want to address this not just to your listeners, but to the off-exchange market makers that might be saying, we don't want these auctions. We've proposed them. We need your feedback. We need your input. But the reason we did this was to instill greater competition. When over 90% of your marketable orders are going off exchange to a small handful of wholesalers that are not necessarily competing order by order, wouldn't it be good to get greater competition there? And so for a segment of the market, trades less than 200,000, we said, those should really probably be exposed. Trades from natural persons and the like, trades be exposed to greater competition, particularly if they don't get you better than the middle of the market or better. And guess what? On the trades that they're giving you maybe a tenth of a penny or a hundredth of a penny price improvement, like 3/4 of those have mid-market prices available. And so our economists looked at this and they said that's about $1.5 billion of further price improvement that could be achieved. Why were we, in the proposal, you say, why were we detailed? Why did we have so many details? We were trying to lay out something that could be a fair auction mechanism. But give us feedback. If the time period should be shorter, we should hear that. If the time period should be longer, if it should be something different. But we're trying to make sure we can instill greater competition through this proposal. And look, it might even tell you that we need to hear from people that say, not only do we support the other rules, but we want greater competition through what's called regulation best execution, or in this auction rule as well.
Oh, and the proposal was very detailed, for sure. It's a long read. It was excellent analysis, I thought. I thought it was one of the best written SEC rule proposals that I've seen, and I've heard from a lot of people in the industry that same kind of feedback. I think a lot of people who I see on Twitter or Reddit, they want you to close the dark pools. And the SEC has some authority apparently to do that. And I think this is a good chance, real quick, just to clarify that, that's not where retail trading is taking place. Most retail trading is taking place in these off-exchange internalizer and wholesaler systems. And that, in fact, this rule proposal would significantly change the way that trading takes place and would push most of that trading onto lit markets.
Yeah, I think that there's 3 or 4 ways. In each of the rule proposals, there was a way. The auctions we just talked about, in what was called regulation best execution, meaning that when you give a trade to a broker, they actually look around the market and consider the various available prices and to try to achieve best execution on your behalf, given the time and the nature of the markets. We effectively said, in a conflicted transaction where you might be getting a payment for order flow in a conflicted transaction, you had a heightened responsibility of best execution. And separately, in a rule around the minimum increments, some people call it the tick size rule, but the minimum increments, we sought and proposed that there would be uniformity, harmonize, that the off-exchange centers couldn't have an advantage and be trading at smaller increments than the quote increment. Now, I think we're going to see some commenters come in that say, drop that best execution rule, or drop the auction rule, or don't harmonize between the dark markets and the lit markets on these fundamental rules of the road. And to the extent you agree with them, of course, tell us. But if you disagree with them, we need to hear that as well.
Yeah, I think a lot of firms who have enjoyed an advantage, a regulatory advantage, and stand to lose that might also stand to lose money because of that.
Let me try to also address, and I see that you have somebody that just came on, but let me just quickly, Dave, say this. Look, the competition between the lit market and the dark market also can benefit retail investors. But if it's a level field, you get the best competition. And that's what we're trying to do. Is best execution means best execution, that you level the field on these minimum increments, and that if they're on these retail marketable orders not willing or able to give you mid-market or better, put it into some competition.
Yes, thank you. So I'm going to bring up JBrown now. Jay's got a question on the best execution rule.
All right. Hey, Chair Gensler, how you doing? I mean, I can call you Gary because you told me I can call you Gary the last time. So
yeah, you can call me Gary. Everybody else does.
Yeah, we're going to be a little informal. My thing is, the first question I asked you on the last time we spoke was, what was important to you? Because that was before I started to read the actual proposals. After being about 900 pages in, you're right. But my question to you now is that I'm leaning more to trying to understand the banning of payment for order flow, because in these proposals, I see certain things stripped away to make it less of an incentive for broker dealers, make it less of an incentive for market makers or hedge funds to even participate in payment for order flow with brokers. But if you look at 2004, when Citadel says, hey, this should be banned, we should get rid of it. If you look at the UK saying this should be banned, we should get rid of it. I think what I got a lot of feedback from other retail investors is, why not just go ahead and ban it? Because in my point of view, if we are trying to make the capital markets fair, I shouldn't have to remove myself out from my broker and put it into my name in an entirely different transfer agent so that I feel secure that I'm getting best execution. I'm not trading off exchange. I'm not going through internalizers within that particular firm, because to be honest with you, some of them that call themselves market makers, I just think are high-speed speculators. I'm just being honest. But to strip away some of the incentive and some of the inducements, it doesn't necessarily calm the spirit to know that this thing still exists, because after all, we know who created it, right? We know where it came from. So my question to you is, why not just go ahead and take that step and say, okay, I propose it gone? Because the market was bracing for that. It was all over everywhere. We talked about it. And then we get the proposals, and I believe that they do have great things in there. Sub-penny, best execution. These things are all needed. But I think with the engagement of retail investors, because I remember we talked about it, it was 100,000. I really need to impress upon you that this is a worldwide thing. Like, we have apes, we have retail investors in every corner of the world that look at this stuff. And if you can't tell, you can look at when you have an SEC meeting, how many people are tuning in to listen. Why not go ahead
file at this point?
Why not go ahead and take that step? Because I think that's where the disengagement comes, right? That's where the disengagement and negative sentiment comes from, is that we are pointing out these things. These things have already been proven. What is it going to take to get it done, and who to direct us to get it done? Because right now, I'm a stair-step type of guy. I believe one rung at a time. I can't jump in, so that's why I'm here asking you these questions.
Do I call you Jay?
Yeah, it's fine.
All right. Jay, look, I think you raise a good question, but actually we tried to go in the proposals directly at some of the conflicts and some of the lack of competitive level field. I actually think we went further. I don't know that you were saying this, but some have said we went less than, as you said, maybe banning payment for order flow. I think we were trying to go directly at each of the components. That importantly, that there would be, we'd harmonize across both the dark market and the lit market these minimum trading increments, that we would ensure that if you put a marketable order in, you had to get some competition unless they could get you mid-market or better. And then even in the best execution, I would note, it's just in the current system, there are brokerage houses that use payment for order flow, but there are also brokerage houses that pay no payment for order flow, that are still sending their marketable retail orders to the wholesalers. And so even, I'm just going to say, even if there was no payment for order flow, the bulk of marketable retail orders are going to the dark markets. And we thought,
generally,
how can we better instill competition for those orders?
But that, it's I've heard that, of course, argument made before, but of course, the firms that don't accept payment for order flow for equities still do for options. And one could wonder if, not taking it for equities is more marketing than anything else, given that 70% of payment for order flow is in the options market, right? Now, we know in 2004, Citadel said the practice of payment for order flow creates serious conflicts of interest and should be banned. We know Singapore last year banned payment for order flow, saying that it introduces conflicts of interest, is likely to cause harm to customers, and is inconsistent with the duty of best execution. Banned in the UK, banned in Canada. Virtu was a longtime advocate for banning the practice and instituting a trade-out rule. It seems like there's a lot out there to support just an outright banning of both payment and rebates, as well as unnecessary off-exchange trading.
Yeah, I'm sorry, Jay. What I think that we did in the proposals was to go through to the underlying conflicts, because there are inherent conflicts in payment for order flow, but there's also this lack of a level playing field. And so you're right that a number of the brokers are not even paying for order flow, but still are routing without checking the market necessarily for best execution. So we thought we ought to do that. We ought to do this proposal on the auctions and otherwise. Again, we get the feedback, and your feedback is going to be very helpful in this. But
Okay.
Jay,
I think
quick, Jay, we got to move on to Alex.
All right, real quick. Just in the grand scheme of things, I think that is the core of the frustration with the SEC. I mean, it's what I hear every day, is that your own data shows that it harms. You know what I'm saying? Like we pull all this information from all everywhere, and it shows that this right here is a direct harm to retail investors. This particular thing. Now we can talk about, off exchange trading. We can talk about internalized. We can talk about it's so many different things that we're into now that we weren't before. But I do believe that having these conversations and bringing these things to the attention and to the forefront lets you have a clearer picture of where we are educationally with knowing how markets work and doing our best to do it. Because the thing about it is, on one hand, you have these conversations. On the other hand, you got the pitchforks. And I'm sorry, both are valid. You know what I'm saying? That's where I'm at with it. So thank you for having me, man.
Jay, before you leave, if I can just say, we need to hear if you have disappointments and thought we should go and do something different or further, absolutely. But also recognize there's going to be a lot of comments that we get saying we shouldn't even have done what we did. We shouldn't even have done the auctions or the best execution or the harmonizing the minimum increments. So so please make sure that focus and let us know in appropriate ways if you think that the things that we have in there help the markets and help the efficiency. I mean, we even lowered the maximum they could pay or charge for access to the lit exchanges. So we also did something on the lit exchanges, trying to lower the cost there from 0.3 of a penny to 1/10 of a penny. But we need to hear back from you and others. But I appreciate what you're saying around payment for order flow.
Yeah, we'll
Thanks,
make sure
Appreciate
we stay in contact with you and everything. And I appreciate your having us because you're going to hear from the people, right? So let's go.
You're our clients.
Right.
Right.
All right, Alex.
Yeah, it's true. And really picking up exactly where Jay left off, and everyone else that's participated both today and in December and over the course of all of these meetings, I think a common theme and thread that you're sensing is that folks, individual investors, feel disenchanted and disenfranchised. They are undertaking their own research efforts, their own initiatives to try and re-empower themselves within a system that they feel has left them behind. I want to raise a difficult topic arising from last summer. It was shortly after we met for the first time in May of 2020. The SEC released a series of videos in June of 2022. And those videos portrayed many retail investors in a less than favorable light. Today, I got messages from many folks, and I'll just read one from a wonderful woman who's engaged with us many times, Catsinbranches. And essentially she said, I believe those videos the SEC released last year really pushed people away from feeling like the SEC might actually be there to try and make positive change for individual investors. Since in the videos, they basically implied that retail investors are dumb for investing in certain meme stocks. So folks took an issue, number one, with the portrayal of retail investors, individual investors themselves, and then number two, with the categorization of certain investments as meme stocks. I want to give you an opportunity to comment on the reflections that potentially you form from now having engaged with us for almost a full year, and whether you think that those videos aptly portray the individual investors.
I think we benefited from the engagement. I know I have, but I think our agency benefits from the engagement broadly with the retail investing public, but more specifically with the community that you're talking about. I think the research is also, it's been very, it's been helpful, and it's encouraging that we might not fully embrace every idea. We just had this conversation about payment for order flow versus the proposals that we made. But I can tell you that we have benefited, and I think we've also been able to be encouraged in proposing things, and the 5-member commission, each of us considering those. In terms of the investor education videos, what our Office of Investor Education often does is tries to put things out and encourage a public discussion and a dialogue. I would say the video that you're referencing certainly has done that. But I got to tell you that I think that whether it's in the Reddit community, whether it's in other forums and social media and so forth, when I have the chance, and I unfortunately don't have a lot of time, but when I do read, I learn from it. So I find that there's, whether it's an individual investor doing research or a group in a Reddit channel or other channels, it's very beneficial, and I've learned from it. I hope that answers your question, Alex.
Yeah, it does in part. I just want to just echo again the sentiment that, the video in particular was talking about how individual investors need to do their research, and that their research would drive them away from necessarily investing in whatever the basket of meme stocks was. And, what I'm trying to emphasize here is that clearly the folks that you've engaged with over the past year are very well researched, very educated in their investments. And that research hasn't led them away from passion and support of these particular companies. So that's all I'm trying to.
Yeah, and I think that research is important. And certainly I know that there's an awful lot of research in this community. We had this discussion earlier about fails to deliver and direct registration. There's a lot of research also about our rules, and not just the companies. What's really important, and I think we as a nation made the right choices in the 1930s, roughly right choices, around that investors get to decide what risks they want to take as long as they get full, fair, and truthful. And it's really important, full, fair, and truthful disclosure. And in the equity markets that we're talking about here, that we ensure that you do, that investors get that full, fair, and truthful disclosure. We're having similar debates in another field, in the crypto space, where that's a more non-compliant field, and that's a field that needs to kind of come into compliance so investors can make their own investment choices about benefiting from that full, fair, and truthful disclosure. In this equity market space, it's often about the structure of the market, and is the structure fair so that the competition for what I would say the investing public, the broad everyday investors public, those are sweet orders. There's actually an rationally economic benefit that market makers should want to pay more from somebody selling 50 shares than somebody selling 50,000 shares, right? And so, the investing retail public, the everyday investor, should sort of get the benefit of competition and the best execution for the sweetness of those orders.
But do you think it was a mistake to label a group of companies meme stocks? These are public issuers. Was that the right thing to do?
Dave, that happened before I was even in this job in April. I don't know where that term came from, out of January of 2021, when we issued a report. I think we called it the GameStop report. So that's I think of them as individual companies and individual issuers.
Okay, and that's how we think of them, and we think of as individual investors as well, right? There's this often characterization of us as retail, and it makes us sound like the product instead of actual.
No, that's a good point, Alex, and that's a term that probably predates.
It is, and it's pervaded, and I think it's something that as time goes on, we should try and just shift what is the dialogue and the focus of it. But no, we've greatly appreciated having you here.
I know we're
individual investors making their individual choices based on their research or collective research on individual issues, as long as the issuers give full, fair, and truthful disclosure, and the market mechanisms, the systems, are fair and competitive. that's the gold standard.
That's right. And then I would also add that, look, it's Wall Street. There will be wrongdoing. If there's anything that we can say about this industry, it's that there are people that break the rules. And, I do think that there's a big concern out there. And it's one that I've expressed plenty as well, that often the answer to rule breaking is a fine. And a lot of companies have started to see these fines as a cost of doing business. Is that the right approach from an enforcement perspective? I know we're over time, and if you don't have time to answer it, understood. But why
don't I close out and try to answer you? Because
and also just to close it, like, what would it take for a broker to lose their right to operate? Like, how many hundreds of millions of dollars and misrepresentations to their clients and lying and manipulation does it take for someone to actually lose their right to operate in the industry?
So just on a broader sense, I'll try to answer, and then I'll try to close out with a thought. Look, the enforcement tool of an agency like ours, we bring about 750 cases a year or so. And we could use more resources from Congress, by the way, because we really could. I mean, human nature being human nature, there's wrongdoing. It's not just about finance. But I would say that we really do look through our enforcement tools to look for cases that hold people accountable and institutions accountable. Accountability. There's nothing like accountability that can really move and change behavior. I think secondly, we look at the real economics. We look at what is going on underneath. And Chief Justice Marshall said it's not the labels. It's really about the economics. We do from time to time look at cases that can send a message to other in the market and try through those sort of cases to send messages through the market. And we do, to answer your other question, from time to time hold brokers accountable and bar them from the industry. That's usually individual brokers or their sort of associated broker dealer. They of course have their rights. They take us into court. They challenge us too, and that's the right system, because you want everybody to be protected that way as well. I would just close out. Look, we at the SEC need to get the feedback, not just from an hour dialogue like this, and this will go in our administrative record on these 4 rules, but to hear from you in terms of comment, what you think worked in these 4 proposals that we put out there, what doesn't work. Though some people will sign into form letters, those are helpful. But if you have research, back to Alex's point, if you have research on a point of one of these rules and you say, look, I think that you should have a different mechanism, little different details on the auctions, different latency or whatever, or did you think of this in this best execution or on the minimum increments, let us know. Let us hear from you. And it helps us do our job on behalf of the individual investors out there.
Yeah, well, we definitely want to thank you for your continued engagement. I do think it's meaningful, and it shows that individual investors are being heard, and I think that's important. And I can assure you, we are going to fill up those comment files, and as they already are. And I think that's even before, as an organization, we've gotten started on our comment letters and our comment letter campaign next month. But again, thank you for joining us, and we look forward to hopefully doing it again.
Thank you so much, everybody who's been with us.
Yeah. All right. So that was Chair Gensler from the SEC. We really appreciate him joining us. We're going to continue the conversation. So we're going to stop the video stream on YouTube and Twitter. But if you are on Twitter, jump over there. We've got a space call going, and we're going to have everyone join there. We've got a bunch of people on it, and we'll keep talking about the new rule proposals. We'll debrief about the conversation that we had, and hear what you think here, and continue to to press to try and get answers to questions that everyone here thinks are important. So thanks everyone for joining the stream, for all of your helpful questions. We tried to hit as many as we possibly could, and we'll hopefully have a chance to do it again.